Ronald Siyoni, the lead analyst of research at ICICI Securities, is joining us on the phone line right now. Ronald, good afternoon. Thanks so much for joining us. First up, give us your outlook on the entire real estate space. What are you liking? I believe you have coverage on DLF. Talk to us about the kind of growth the company has seen. What's your outlook? How do you rate DLF? What's the target for the stock? Because we've seen a lot of strong fundamental factors coming in for DLF, the likes of their Dahlia sale that they have done. 12,000 crore in 9 weeks is no small feat. Do you believe this could sustain for the company going ahead, and do you also believe luxury real estate demand could continue to see such traction going ahead?
Yeah, thank you very much for having me on the show. DLF had shown a very strong performance during Q3 of FY25 with Dahlia's launch, and they had surpassed their pre-sales guidance of 17,000 crore for FY25 in 9 months itself. And going ahead also, they have key launches, including the Mumbai launch in Q4 expected. Then there is a Goa project launch. There is another Privana Mumbai second phase launch is also there. And there is a Dahlia's inventory, which is around 23,000 odd crores. Overall, we see, during the period FY24 to FY27, we expect, pre-sales growth to grow at a 22% CAGR for DLF. Also, the annuity income has also been very good with, occupancy increasing, and there are also new assets additions expected along with rental escalation. So overall, in the annuity portfolio also, we expect a 13% CAGR over this period. So Delhi NCR market, as you know, has seen a very strong price rise over the last year and has been, predominantly driven by the rising share of the ultra-luxury properties, which are priced more than 2.5 crore. So the share of which has, moved from 2% in calendar year 21 to about 59 to 60% in calendar year 24. So there has been a strong momentum in this market, and there are, few quality developers in this particular region which have, the capability of luxury or super luxury kind of development and execution. And DLF, after witnessing such a sharp correction, as the sector has also witnessed around 20 to 30% odd correction over the trailing 6 months. So we believe DLF now is, at closer to its NAV valuation. The realty sector as a whole, the premium which they used to get on the NAV, which factors the ongoing and the medium-term launches. So the premium which is assigned over and above that has vanished completely for most of the stocks. And some stocks like Max Estates, which we also have coverage, so that is now trading at a discount to its NAV valuation. So overall in this space, we prefer DLF, we prefer Oberoi Realty, we prefer Max Estates. For DLF, we have a price target of 1,000. For Max Estates, around 741, and for Oberoi, 2,100. So overall, if I talk about the sector, sector for FY20 calendar year 24, there has been more of a pricing-led growth, value-led growth rather than volume-led growth, as because of obvious reasons of general elections. So hence the outlook is such that prices may not move up as we have seen in the past year.
All right.
And
yeah. But Ronald, the other point we wanted to understand is with respect to the Mumbai registration data, because the Feb data, when they're out, we are seeing very divergent trends in terms of the high-end segment that has gained 15%, but on the contrary, the lower ticket size segment has seen a 19% YOY reduction in demand. Is this a case for the other parts of the country as well? Like, can this trend replicate, and why do you think that this is happening?
So yeah, not only in the real estate sector, there has been premiumization in each and every sector, and premium categories have shown much more, growth rather than in affordable or mid-income category, whether you look at it in any other sectors. So real estate has not been, different from that. And overall for FY25 till date, we have seen about, if I talk about Mumbai, then there is a 9% growth in overall number of documents registered, and there is 19% value-wise growth. So yeah, the high value ticket size projects have contributed. But if we talk about these real estate companies which are listed, they are more focused to this segment only, which are upper mid income to luxury to super luxury segment. So their target market is already going at a good pace, and the mid income and affordable, especially affordable category, has been underperforming for quite a good time, because interest rates are still much higher, and hence these companies are favorably placed to cater to this luxury and super luxury segment. And because of you call it consolidation, or call it execution track record, so they should continue to see good momentum in this target segment. They are not actually present in those affordable or mid-income categories.
I'll appreciate your views on that note. We'll let you go. Thanks so much for joining us and chatting with us on ET Now this afternoon.
If you like this video, then like, share and subscribe to ET Now.